Welcome. My name is Anthony Millen, and I'm the founder and co-chair of Next, powered by Shulman Rogers. On behalf of Next, I would like to welcome you all to today's webinar, Structuring Your Crowdfunding Raise for Success, brought to you by Next and the crowdfundinglawyers.com. Next is an innovative new model for delivering legal services for startup and emerging growth companies from launch through each stage of growth, and has been designed from an entrepreneur's perspective. Next offers predictable and reasonable legal fees through fixed price packages and service bundles. Our clients work directly with seasoned attorneys through a hands-on legal services model, and Next integrates robust technology platforms to create a client-centric experience that is collaborative, efficient, and transparent. For more information on Next, please visit us at www.next.law. I now have the honor to introduce my partner and the co-chair of Next, Larry Bard.
Thanks very much, Anthony, and thank you all for joining us today. We've got a terrific program. I'd like to introduce the rest of our panelists. We have Paul Jossi, a Virginia-based lawyer and entrepreneur. Paul's practice focuses on helping startups raise capital through equity crowdfunding and other provisions of the Jobs Act of 2012. He's also an adjunct fellow at the Competitive Enterprise Institute, where he researches and publishes on cryptocurrencies, equity crowdfunding, and alternative and decentralized finance. Finally, Paul is the founder of the crowdfundinglawyers.com. I would encourage you to visit there after today's session. We've got Ben Maitland-Lewis. Ben is a purpose-driven founder with 2 platform exits. He's a Y Combinator alum who spent the last 20 years in media, entertainment, and technology industries. He recently joined Wefunder as a founder in residence to help other founders raise capital and strengthen their communities. And finally, we have Gary Skolnick. Gary's the CEO and founder of Neighborhood Sun, a Maryland-based community solar company that brings the promise of solar to everyone, not just a select few. Gary's been a leader in the fight for clean energy in the region since 2000, either as an activist or an entrepreneur. As the leader of Neighborhood Sun, Gary focuses on maintaining the company's mission while growing the company's business. And I'm going to start us out here and put a stake in the ground and say, what's the big deal about Regulation CF, about crowdfunding? And not to give a big history lesson, but the first point of reference is to go back to 1933 and the Great Depression and the crash of the stock market, which led Congress to enact a very protective set of federal securities laws. And as a result of those federal securities laws, almost all equity or security investment for the next 80 plus years was funneled into 2 sources, either public offerings, that's your typical IPO, which almost all of you in the audience here today are not doing, and most of our clients are not doing, or private placements. Private placements were focused on investments that either through statutory or regulatory exemptions were made available to people that were what we now call accredited investors, people that either had a high net worth or had a high level of income. And that is as we note on the slide here, it's a very small slice of the public, tends to be geographically concentrated on the coast. And that's the way life proceeded for almost 80 years until the Jobs Act of 2012, when Congress adopted a new set of rules that says we're going to allow companies to raise equity from the public in a regulated way through crowdfunding. And Paul, why don't you tell us what that is?
Yes, thank you, Larry, and thanks to Next and Powered by Shulman Rogers for putting on this webinar. So the Jobs Act actually just had its 10-year anniversary yesterday. So it was signed by President Obama, bipartisan support in the Congress. It got a Rose Garden ceremony and the whole 9 yards. And so what people were expecting, and what has eventually happened, is that everyone now has an opportunity to invest in startups, either hotshot tech companies or just brick and mortar companies in their local communities. And obviously not all of these companies will make it, but now everyone has a chance to get in on the ground floor. So when I talk about equity crowdfunding, I like to talk about first what it is not. And it is not sort of the things that most of the public is familiar with, like Kickstarter or Indiegogo or GoFundMe. This is a professionalized way to democratize investing within the existing securities laws. And we go to the next one. And so what are the basics? So issuers, that's the companies like Gary we'll hear from later on, can sell securities, equity or debt, just like a major company can, but there are vastly different rules that now apply. They are sold through intermediaries, like you're going to hear from Ben a little bit later on. The securities are restricted. They are not freely tradable in the first year, and even after that, there are difficulties involved with liquidity. But there are ways to eventually get your investment return back. When the issuer is setting this up, there are a number of compliance and regulatory matters that you have to go through, including having your financial statements reviewed or an auditor. And then even after post-raise, you will have to have at least one annual report and possibly more than that, depending on company metrics. So there was a lot of hostility actually with Reg CF at the very beginning, even though it had a lot of political support. I'm happy to say that the SEC, who wrote the rules for Reg CF, has substantially warmed to it, and that culminated in new rules coming out last March that freed up a lot of the rules and made it easier for both issuers and investors. And one of the biggest ones was the offer limit was raised from 1.07 million to 5 million. There are some accounting regulatory matters that also go along with that. Very important, you can test the waters. You can discuss the potential of your raise before you go hiring compliance professionals. And this makes it much more akin to a regular crowdfunding where you build up momentum and excitement from the people you know beforehand and your initial investors to then bring that out to the public. The messy cap table, quote unquote, messy cap table was a very big problem at the beginning. That has substantially been solved by what are called special purpose vehicles, where a lead investor now will be responsible for all of the investors. They're put in one bucket and you get one line on the cap table. And there was some other things that happened, not directly related to the March vote, but there's the CEOs can, for up to 250,000, you don't need the CPA involved.
And Paul, forgive me, you may have mentioned it, but in the second bullet, a little bit of harmonization between the crowdfunding rules and the rules that I mentioned at the very beginning is now accredited investors don't have investment thresholds. A company still can't raise more than the $5 million in 12 months, but if you've got accredited investors that are willing to come into the crowdfunding round, they could take up fairly large chunks of the crowdfunding.
Yeah, thanks, Larry. That's exactly right. This is one of the rules that really didn't make a lot of sense at the beginning, that accredited investors did not have limits. Now you can have one big investor put in potentially $500,000, and the assumption there is that person is not going to put in that kind of money without doing their due diligence. And this allows everyone else, the smaller investors, the retail investors, to sort of bootleg off of that and become have everyone come in on the same terms. So it's really advantageous, especially for the little guy investors. Go to the next slide.
I'm trying to, there we go.
So what are some of the advantages to doing this way? There isn't all advantages. It's kind of easier to have a big venture capitalist write you a check instead of doing an entire campaign, which takes a lot of planning in the beginning, and this is not something that typically lasts a week or two. You know, you might have Gary's first raise lasted, I believe, over about 12 months. So, but you do have advantages. Number one, you broaden your investor base. You can incorporate your crowd of potential clients or customers, or people who are already using your product. You can incorporate them into your investor base. This is going to give people an incentive, aligns their economic incentives with your economic incentives as the issuer to make sure everybody's rowing in the same direction. And you get sort of an organic free marketing operation from that, because the better the company does, the better, even if you have just a little investment, you can see your investment potentially grow, and people are more apt to put that information out on, for instance, social media. You can also prove value to institutional investors, where if you can say that, hey, we not only have this many people as say, for instance, subscribers to our service, but we have investors, we have people in potentially all 50 states that are that will give us a foothold to potentially new markets. So you have all of these things that sort of, when it works well, it's a really beautiful thing, and everybody sort of comes together, and you see a lot of success on the back end.
Yeah, just curious, maybe we could bring Ben in here for a second. Ben, is there a, I mean, it's to be a leading question, if I may, but is there a company that's, you know, your typical crowdfunding company? Paul talks about, you know, turning your customers into investors. That obviously works if you've got a great new healthy snack food or a new widget that everybody wants in their house. It might not be the case if your product, you know, is a new gear switch that goes into a nuclear power plant. You know, those people. So is there a company that's your prototypical crowdfunding company, and what do you see in terms of companies that are outside of that?
I mean, great question. The truth is that they're all over the place, right? I mean, we have those like B2C consumer type companies that might have a large community or tap into a big customer base up front, all the way to companies that are like unmanned aerial vehicles testing for methane leaks at factories. You know, I mean, it's all over the place. Obviously, it is a little bit, I would say, smoother sailing if you already have a massive community of customers or people on social or whatever else that you could offer this to. But, you know, I'm literally seeing it all over the place. I'm working with companies every day that are all over. I kind of put companies into 4 buckets, honestly, that are leveraging this, because, you know, with the laws that changed last year in March of 21, that really made the industry really mature in general, because now we can raise up to 5 million. We can streamline everybody on a single line on a cap table. So that, you know, it took 10 years, right? You know, and now here we are. And so you have, in my opinion, 4 different buckets of companies. You have the top level company, like your Mercury's, Levels, and these large guys that are, you know, have a ton of capital. You know, they're raising like 120 from Andreessen or whatever it is. And they open up a $5 million round to strengthen their customers, or essentially in that capacity, reward their customers. They just want to say, thank you, come with us. You know, we want you to be a part of this journey with us. And they send an email and they raise it. Then you have really well-funded, call it Series A companies, maybe maybe growth stage companies that are doing it to retain their existing customer base and tap into a new customer base through the Wefunder community or others. Then you have those that are slightly smaller, coming out of accelerators. Maybe they have some, you know, traction already, things like that going on, but they have a ton of different conversations taking place with angels, check sizes between 1,000 to 25,000 to 50,000, and they can leverage our SPV to basically consolidate and organize everything into a single line on the cap table, then tap into new, you know, communities and customers. And then you have the really young guys that want to leverage a sophisticated vehicle such as an SPV to basically run a friends and family round to get all of their supporters, their early true believers, and early adopters and those people to jump in, help them sort of get this traction going, and then also tap into our community. We have 1.8 million something investor community size. And one thing that wasn't yet mentioned is that with Reg CF specifically, you're allowed to publicly solicit for investment. You're not allowed to do that with Reg D. And you're not allowed to disclose terms, but you are allowed to say, check this out. I am doing this awesome, amazing situation, and I want to build it with the community in mind. Learn more by clicking this link. And that's really exciting because I spent 22 years going from boardroom to boardroom trying to make investor pitches. And so it's really at this point, because the industry's matured so much, it's just spread out the offering to really democratize access to capital for all and allow more founders to get funded no matter what stage they're at.
Right. And that's a sort of a great jumping off point to the next slide when you talk, Paul, about democratization of capital. Obviously, you can look at companies by type, B2B, B2C, aerial photography, but the next slide talks about a different type of democratization of capital raising.
Yeah, this is something that's very important to me, and I think obviously very important to a lot of people in this industry. As somebody like me who grew up in a poor rural state, Louisiana, there are other people, for whatever reason, do not have regular access to capital. I know Lisa Freelander, who does a lot of the behind the scenes work to put these webinars on, does a lot of work with female founders. And so what Reg CF can do is be the great equalizer. It can allow lots of people who have great business ideas, who have not traditionally been the kind of people who get funded. It gives them a chance to get their ideas out there, get exposure for their companies. We've been talked about 1.8 million people on an email list. That's just something that was not able to happen before. And so the sort of cloistered venture capital, elite zip code way of doing this is currently being upended, and that's one of the reasons that I like doing this, and for I think that's the same for a lot of people.
And here we've got some data, Paul. Maybe you want to talk about it. Ben talked about the maturing of the equity crowdfunding raising, and I think these slides really draw that into focus.
Yeah, and you may see the little COVID text there. COVID is obviously a very bad thing, but it has forced people to do their investing more online, and so that is one of the accelerators to Reg CF, along with the rules that were freed up in last March. So this industry. Businesses and startups making this a part of their capital raising strategy is really starting to take off, and we're starting. Obviously, we can see it in the numbers.
One thing I want to. Oh, here we go. Go ahead. I'll jump in on this before we go to the next one. This is perfect.
Yeah. So this sort of goes back to the thing that I mentioned a couple of slides earlier. Is the sort of the geographic disbursement is one of the things that I really like. Obviously, there's still going to be concentrations in the meccas, but as this matures, it'll start evening out, Ben.
Yeah, and we firmly believe in that. Look, I mean, we're a public benefit corp, and in general, like the democratization, like we're all about leveling the playing field, providing greater access. And it's exciting because, we're sort of like flipping it up a little bit upside down is what Reg CF allows you to do, right? Because it's like right now all the capital is super tied up in these states over here. And that's natural. I mean, outside of Illinois or Texas, really, it's just the coastal communities, right? Coastal elite, I guess, if you will. And obviously, like we do have our headquarters in San Francisco. But, our secondary headquarters is in Nashville. We have city leads actually in like Virginia, Nashville, Fayetteville, and Louisville, and Boulder and growing. So it's like, for us too, we're very much like, we cater very much to like Main Street as well as like, your large SaaS companies. And that's what's exciting about this that we're talking about here, right? It's like if you're a small coffee shop or a brewery that wants to expand capacity or whatever else it is, great, we can do that. Typically, those are debt vehicles where you're doing a revenue share program, whatever else it is. You're opening a second location, whatever. If you're a SaaS company or a technology company, great, we can do that too. Typically, those are SAFEs, convertible notes, or price rounds. But you're allowed to then now accept investments globally. That's one thing I want to stress too, is like you might be in, Louisiana, like you mentioned, but you're able to, accept investments globally with a few restrictions. Like right now, it's like Russia, North Korea, 3 provinces, and Canada. So, that's super exciting. Doesn't really matter where you are at the end of the day. If you have a dream, you can make something happen.
Yeah.
See if my screen is there we go. All right. So, some of the questions in the next couple of slides that we're going to talk about are some of the structural points relating to crowdfunding. And frankly, they're to some extent the same questions we get for all sorts of capital raising. And that is people, our entrepreneurs, our founders, they either have an LLC and they want to raise capital crowdfunding or through a Reg D offering. And then the question is, should we be a C corp? And the typical answer to that question is, in most cases, almost all of our clients and all the people that we see raising capital, you certainly want to be a C corp before you take on equity funding. And that's just because it's typically people understand what it is to buy a share of stock. And it's a little more confusing and more complicated to buy an LLC interest, although it can certainly be done. The other thing is that people typically use LLCs for pass-through treatment, and that's for tax purposes. There are ways to do that with a corporation. It wouldn't be what we call a C corporation. It would be an S corporation. But in all events, once you're taking on, mom and pop investors, you don't want to have pass-through treatment. Pass-through treatment means you're basically you're a partner. You get what's called a K1. Your proportionate share of the entity's income and expenses will go through to the partner or the person getting the K1, and you complicate somebody's life immensely. What I like to tell people is, for $1,000 investment, you've given them a lifetime of $1,000 a year accounting bills to prepare their tax returns. And so you can't do that. So most people, at the point in time when you're raising equity, you want to be a C corp. There are also complexities with issuing safes and notes as LLCs. So I would say, if you did a survey on Wefunder or any of the platforms, you're going to see most of the companies out there are C corporations. Most of our C corporation clients are Delaware corporations, but not all of them. And the reason most people choose Delaware is because there's a familiarity and a sophistication with the Delaware corporate code. We certainly have clients, being here in Maryland, with Maryland and Virginia. Gary's a Maryland company. DC, I try to steer people away from. I don't know if there's anybody from the DC government here on the call, but they tend to be less company friendly. We do get a fair number of companies or entrepreneurs and founders approaching us from overseas. And in almost all scenarios, we end up in some way, shape, or form moving their company into the US to start their capital raise on a crowdfunding platform as a Delaware corporation. There are a variety of ways, depending on the jurisdiction where they're starting from and what their capitalization table looks like in whatever country they're in, to move them, from being a company in the UK, in Italy, in Portugal, into being a Delaware corporation. So there's no particular roadmap, but that can be also a pretty a tax intensive driven decision on how that happens. But almost all of our clients that are interested from overseas end up moving all of their operations sometimes into being a subsidiary of a new U.S. company moving their shareholders into being shareholders of the new U.S. company, and then proceeding with a very happy life in the U.S. And that goes hand in hand with a question that we get from our crowdfunding clients, that we get from all of our clients that are raising capital, which is, what sort of an instrument should we use to raise capital? And the typical choices, although not the exclusive choices, are whether it's equity, and that would be common stock or a class of preferred stock, or debt, and that would typically be a convertible note or a SAFE. And there are a lot of things that go into that decision. The primary driver is if you're doing equity, straight equity, whether that's common stock or preferred stock, you have to have a valuation of the company to decide, what's the price per share. And not all, and Ben has mentioned a number of clients that have done Series A and done Series B, or are doing parallel or concurrent raises, and they're bringing their crowdfunding investors along for the ride. But in that scenario, they've got sophisticated investors that are involved in a concurrent or the same priced round that are helping determine the value proposition and the price. One of the main benefits of doing a convertible note or a SAFE is that you don't need to come to a company valuation in order to do that round. So, and the documentation tends to be a lot slimmer, a lot more streamlined. So for the same reason that we have most of our early stage clients up to a point doing convertible notes or doing SAFEs, and the SAFEs tend to be a little more company friendly than a convertible note, just because they don't have a maturity date, a point in time where if they haven't converted into equity, the investor is going to come knocking on your door. Most of our clients will do convertible notes and SAFEs, and I think for most of your early stage companies on the Wefunder and all of the portals, you'll see companies issuing convertible notes and SAFEs. Again, you've got common stock there. You've got price rounds, in price preferred rounds. I would speculate that most of that is coming in after there's been an institutional investor that's done a price round and given everybody a level of comfort with the value proposition that's there. And I'll just put a word of caution on, we have a lot of people come in, and no offense to Ben or any of the other portals, but they'll come in and they're like, we're ready to launch tomorrow. We've got the Wefunder papers. We've signed everything with them. We've got their convertible note and we've got their SAFE. And we end up doing, we ideally, we and Paul will speak to them before they have gone live on a portal, and we have an opportunity to work with them and help them understand what are the features of the standard templates that are on the portal for a SAFE, for a convertible note. They tend to be generally good forms, especially now. We have, unfortunately, now a number of companies coming to us for exit transactions that issued what I'll call, that were involved with first generation instruments, and not necessarily from the Wefunder, but from other portals. And in the exit transaction, some of these instruments that were issued are making life complicated for companies that want to do, for example, maybe a stock for stock exit, but because the buyer is private and doesn't have a way to get, again, you need a private placement. You can't issue in a stock for stock merger. The buyer won't be able to issue their shares to the old crowdfunding investors through a new crowdfunding. So they need a way to issue those shares, and you end up needing a fair to some of these older deals to exit the instruments. You sometimes need more cash than is available in the transaction. So we've been wrestling with that. But all that is to say, and Paul will talk about this more later, it's always good to have company counsel take a look at the paperwork involved with the transaction, the security that you're going to be issuing, to make sure you understand it, to make sure there aren't a few tweaks that you might make or might propose, at least, to make the instrument more company Favorable.
Can I jump into this real quick?
Yeah, absolutely.
Actually, you brought up a couple things that are super relevant that I want to just kind of touch on. I agree with everything that you said 100%. I can't speak for Gary, but my eyes glaze over when I look at contracts. My dad was an attorney, and he advised me very strongly against going into law, even entertainment law, which is where I always spent a lot of my time. I glaze over. I'm sorry, with respect and to what you guys do. And so it is important to have counsel to be able to look through and make sure that you understand everything that's going down. Now, obviously, for us, we've been doing this for a long time. We have standard contracts to make it very easy for companies to be able to get up and running. Traditionally, there's safes, convertible notes, price rounds. But that doesn't mean that, hey, that just, click a button and there's 30 pages that you're agreeing to and you don't have to read them or understand them. And so that's where that really does come into play. Secondarily to that, just because we provide, templates, and maybe the other guys do too, doesn't mean that you can't change those, edit them in any capacity that you want, have a custom agreement and whatever else. So yeah, I agree 100% because I'm one of those individuals. I'm typically one of those guys that doesn't read the fine print and asks for forgiveness later, and that ends up being very expensive, but that's just me. On the other thing that I also just want to bring up very quickly is that because the industry changed and matured last year in March, right? A lot of people out there will actually talk kind of down sometimes to what we, crowdfunding, and we get it. It's a term that we don't even like either. We call it community rounds, but it is what it is. It's regulation crowdfunding. Come on, we were there. We were there at the Rose Garden when it got signed into law. But it's a headache, and I feel for you guys, to deal with this because there's some companies that call it older generation, like you mentioned, right? Pre-March of 21 that raised. That weren't allowed to consolidate all of their investors onto a single line on the cap table. What we're doing now as an organization is we've built a merger tool, and we're working with a lot of companies, Gary's probably included, to merge a lot of those to a new SPV to sort of streamline it back down. But there are some companies where, if they raise pre-March of 2021, they've got, in some cases, hundreds of people on their cap table, and nobody likes to do that. And so, I just stress a lot of what I do is re-educating people because they'll come with that additional stigma of blah, blah, blah. But in reality, no, that's just a pre-March 2021 law. And that's another reason why it's important to talk to people like us and like the people on this call, because they know what's up. They keep up to date with the laws. And we don't obviously expect you to keep up to date with the laws. But it's important to know that. So, cool.
That's a great point, and we were lucky enough to get in with the SPV, so we don't have hundreds of people on our cap table, and I also did choose to work with Paul and Larry to do our legal documents, not because we don't trust what's out there, but really more just for the comfort of having the ability to customize it to what we're trying to do and make sure that it's going to work for us in the future.
Love it. Well, I guess this is a good transition into my slide. A lot of this has already been covered, full disclosure. So I guess I'll just cover it maybe from my perspective. I'm a founder and resident at Wefunder, as well as just a founder for 22 years. And that's still the hat that I have on. I just now get to work with a lot of founders. And so quick background is that I ended up joining Wefunder after my second VC-backed exit, not even knowing about this industry, and joining for two reasons. One of which I was frustrated that I didn't know about it and didn't take advantage of it. On the other side, I was super excited and just driven to make sure that more founders took advantage of this. Obviously I came in the right time because it was post March 2021. And so all this stuff was kind of cleaned and matured. And in a way, the industry is now in its teenage years with, shiny braces on. We're still very young, but it's growing, and it's really exciting time to be doing what we're doing. And so, for us, obviously the industry, it's regulation crowdfunding that we're talking about, right? The ability to raise up to 5 million from unaccredited investors globally, as well as obviously accredited investors side by side, right? We're democratizing access. We're leveling the playing field. We're getting more founders funded. We're strengthening communities, building a deeper, stronger moat around these companies, and building more resilient companies in the process, right? Because if you have your customers as investors, hey, now you have evangelists, and that's the whole vibe, right? Yesterday was a very exciting day. Just as Paul mentioned, 10th anniversary of Reg CF and the signing of it and the Jobs Act. was also the day that we launched communityround.com. It's sort of our take at rebranding the entire industry, because some people still have a negative connotation around crowdfunding. Maybe some of you do on this call, and that's fine, because of course we have Kickstarters and GoFundMes and everything else, and that's just what people think it is, but that's not. You are building a community of people and evangelists that are going to be with you through the life of your business, and that is very important. Hence, a community. You are building a community. So we call it a community round. And the benefits of that, like I said, I mean, look, Paul, Larry, I mean, everybody's already touched on this, and maybe I'll just spin it a little differently. But at the end of the day, look, I spent 22 years literally going through accelerators, boardrooms, doing angel presentations, pitches, and everything else to hopefully get 1 to 10 guys to write me checks to allow me to keep going. At the end of the day, what happened is that, I had many different deals on the table with different sort of variable pieces of influence. I was reporting to many different people, and I had to report to sort of different gatekeepers. And all of a sudden I had 10 parents that I had to report to. It was a little annoying. It slowed me down a lot of times, and it didn't really add a lot of value to me outside of that just initial big check, which of course it's exciting to get a big check. But, at the end of the day, they're also not customers, and they're not necessarily evangelizing what I'm doing. So for you to be able to open up a round for your customers in your community alongside these big guys is very important. Strength in numbers, huge there, right? You're building the moat around your business, like I mentioned before, and you're able to engage a global community and build a global community. You can, bring in these high net worth individuals and have them act as a lead investor. For us, at least, for the SPV structure, a lead investor is typically somebody who puts in maybe 5% of the round, but the minimum is only 1,000. So your barrier for entry there isn't bad. All they get is the ability to have the voting right for the SPV. So one person gets to vote for the whole community of investors that are within that SPV. And that's really important. And so that person can either be a really good friend, an advisor, an investor, or a celebrity. And we've had people like Bill Nye be a lead investor, and that's pretty cool. But at the end of the day, it's somebody that you trust, which leads me into like the investor sort of risk mitigation. And that's really important, right? Because again, investors, they like influence, and especially the more volatile you are as a company, the more influence they want. But if you can sort of control that influence and keep them at bay while you focus on building your product, the better, more successful you're going to be in the process. And that's where I'm at with that whole piece. We have a growing community of investors, of course, that tap into, so do the other platforms. The most important part here is that we are really helping sort of like these middle markets, private markets, like participate. Our average investment's $1,000. I've seen checks over $1 million, but the starting investment's typically $100. That's awesome. That's like 6 or 7 burritos at Chipotle. And now I can own a piece of a company. That's really cool, and you can be an investor, the accreditation process is ridiculous. And that's only getting harder. And so this allows you to really kind of have people be involved for something that's pretty much trivial amount of people. I mean, honestly, a date for 2 to movies with popcorn, that's probably over $100 at this point. Anyway, building, obviously you're strengthening the community, you're bringing that next round. Let's say you're worried about the Reg D side of things, or if you do crowdfunding, am I not going to be able to go get VC funding because they're going to look at it bad? No. And if they do, they're not the right investor for you. Because the way I look at it, and the way a lot of other people look at it, is that it's strength in numbers, and it's one line on the cap table. So if you can go back after running one of these rounds and you go to these VCs or anything else, we're not anti-VC, we're not anti-angel. We actually like to work harmoniously together. But the point is that you're able to go to them and say, check it out. I actually have, I've been able to leverage the community and build a community to get to the next milestone or 2 or 3. And these are 3,000 or 4,000 people that are evangelists for my company, and they're not going anywhere. Your LTV goes through the roof, your CAC goes down to a negative, and they can't argue with that, right? And they don't have influence because they're not on your board. They just, can help you, and that's exciting. And then lastly, we personally, we're a public benefit corp. We just care about getting founders funded. We, in general, have very straightforward, fair pricing. And so as you kind of look at the industry and you shop around at different platforms, I encourage you to also, obviously take a look at us, but in general, look at and make sure that you're also looking at their fee structures, because in some cases it's incredibly ridiculous. And so we've been building this for a very long time. It's just the good guys in the room. We have 42% market share as of last week. And we just launched Community Round yesterday. Take a look at that. And educate yourselves. But we're always here to support in any way possible.
Thanks, Ben. Ben, one question before we turn it over to Gary. Just to make sure we're all clear on some of the terms that you're talking about. Is the lead investor the same as the anchor investor that people need to start their round, or maybe you could mention what that is?
Well, if you're talking about, specifically to Wefunder, because that's the world that I know really well, and other platforms do it differently. So, to speak about the world that I know really well, the lead investor, doesn't need to be the anchor. Most lead investors come in with only 5% of the round. The lead investor is just somebody that you assign, almost like a custodian, if you will. I don't like using that because then that gets mixed up with custodian models. But we call it a lead investor, and that person is literally just, they have some pro rata rights and some great benefits and perks for being a lead investor, but they're really just somebody that you trust to put in charge of that SPV to eventually, once it converts to equity and you're going down the line and you need a vote, they're the one who can just raise their hand to make that vote for the entire pool of individuals. And you're not dealing with 2,000-3,000 people or whatever to get consensus.
And then what about the anchor investor? What is the anchor investor?
That's the first time hearing about it. If you're talking about traditional.
Sometimes we hear on some of these platforms, and maybe Paul will jump in, that somebody will say, in order to start, I have to have $50,000 committed.
Well, we do have that. We have a minimum of 50. Our minimum is 50K when it comes to that. And what we do is we actually work with our founders to get to that initial commitments from their community. And that is for a few different reasons. And we work with them. We have a whole launch team that works with them and everything else. And we have, priorities and project plans and templates. And, Gary will talk to this because Gary works very closely with my team. But in general, we do that for many different reasons. One is we believe in the community. Right. And what better community to first reward and first invite than the founder's own, right? And the company's own, friends and family, existing customers, people on social or through press, because you're allowed to publicly solicit, right? Partners and their partner networks, right? Offer this out. Let's go. Let's get the community involved. And so we work with them there. Secondly, to get that first 50. And then at 50, then, they can tap into our community and different triggers take place at different points. But the point of that is really to get those initial people rewarded first, as well as build up as much of a pot as possible. Because as one of you gentlemen mentioned earlier, a lot of the investment community that is on this, out of our 1.8 million or so, about 5,000 are accredited. The rest are armchair investors or retail investors, or however you want to look at them, people like me. And I might look at things a little differently, but in general, they're not digging through your financials and your EBITDAs to look at your P&Ls and all this other jazz. They're looking for validation, and they're looking for first and foremost, people invest in founders they believe in tackling challenges that they believe in that have an impact, and they want to be a part of it. Let's just get that out of the way, because what Gary's doing is epic, and that's partly why people want to be a part of it. They're just like, yes, I believe in what he's doing, and I want to be a part of it. Let's go. But, they're also looking to be like, are these guys raising money? Are they going? Is it moving? Is it closing soon? And then that FOMO, that sort of human psychology kicks in, and we want to do that. So that's why we have that $50,000 minimum. And it also kind of proves to us that, they have something there, because you can't just come to a platform like ours and expect us to do everything or throw up a deck and raise a boatload of money. The average raises are between 4 to 12 weeks long. Some of them close the single email. Some of them take longer. Some of them take longer strategically because they take some money off the table first and do a rolling raise to keep it as part of their growth and, customer acquisition. So I'll pass it on. Apologize.
Thanks.
Yep.
Thanks, Ben. So speaking of founders that we.
Hey, Larry, just one more thing real quick about the lead investor before we go. To Gary is, and this is, I admit I didn't know this, dealing with the Wefunder platform, is that the lead investor can actually does not have to be a natural person, but can be an LLC. And so that maybe has some advantages for people that are looking to find that lead investor.
Yep.
Great, thanks, Paul. And so we save the best for last. Speaking of founders that we all trust, Gary, you did your you successfully completed one crowdfunding campaign, and that was, I believe, after you had already done a priced round. But certainly would be good to have you tell us, Neighborhood Sons story, what you found attractive about crowdfunding as a way to raise capital and validate or poke holes in some of the things that we've said already.
Yeah, well, I think I will be validating it all. I'm very pumped about crowdfunding, and for Neighborhood Sun, it was just a perfect fit. So we're a company in the community solar space, which is the fastest growing market in the solar world. And the reason why is because everybody can access solar power through community solar. It's not just for the wealthy or people with rooftops. Anybody who pays an electric bill can get the benefits of solar power. We are also a B corporation and a benefit corp. So when we were looking to raise money, we've done some raises through friends and family, through angels. We have a great group of angel investors here in the DC area. We did some priced rounds, but I was really attracted to crowdfunding because it fits our brand perfectly. For us to say we're a people-powered business is not a stretch at all. It's exactly who we are, and it's exactly the kind of people that are attracted to our business. It's also, I find it's much friendlier for entrepreneurs. As Ben was saying, like having to go through these presentations to the angels or the VCs, it's not the best process. It's not the best for your health. And, some of them come on your board and then also exert a lot of control, whereas this process is much friendlier. We are confident in our existing customer base. So we're one of those companies that does have a customer base. We have we're up to 12,000 customers now, actually. So we felt like, okay, we can do this by first going to our customer base. And then it's part of our brand building strategy. We actually got investors in our first round, which we did raise $1 million last year. We had investors through, we use Wefunder. In all 50 states. So that's pretty cool. My recommendation, if you're thinking about doing this, is research the major platforms out there. There's like 3 or 4 that probably have most of the market. Talk to the various stakeholders, your existing investors, if you have any, your friends and family and folks who know, ask for references. Ensure you have a campaign in place. So I think Ben made a great point. Most of the time, you can't just press a button and, you're going to get the money raised. You have to really think strategically about it, like exactly how are we going to do this? And then utilize legal help. We are a customer of Next with Shulman Rogers, and we went with Paul to do the specific crowdfunding. And that was very helpful for me because it's one less thing I have to worry about. I can focus on promotion and getting the word out there, and my lawyers can focus on making sure it's all kosher, and then working with a platform. We ended up choosing Wefunder in part because they're a benefit corporation, so they share our values, but also they have a great team that really helps entrepreneurs to think about strategy and how to launch, and they can look at your specific industry. And some of these guys they've got, like Justin, are just like he's on steroids. The guy is so pumped for us. He makes me excited about my business. He's really a good cheerleader.
I have another picture here, Gary, speaking of teams.
Yeah, so I've been well coached by my legal counsel. I can't talk about our current raise at all, but I can encourage you guys to go to wefunder.com/neighborhood sun. We are live right now. And we decided to do a second raise. So we had a successful raise last year. We just launched our new raise this year, and in part because of the success we had. So we already have an existing investor group from last year's raise that was over 1,400 people. When you go on Wefunder or other platforms, they help you to tell your story, and a video is a key component. And if anybody watches our video after this, you'll see it was not exactly done by Steven Spielberg. This is which fits our brand. It doesn't have to be slick and high production. It just has to tell your story, be authentic, and explain to people in a clear way why they should invest in you and, what the potential exits are. I think a lot of investors don't, especially the armchair investors, don't quite understand that this isn't like on the NASDAQ or something where you buy a stock and then you can sell it. You have to be able to explain that they're going to be holding this for a while, and this is a long-term investment that hopefully will yield a great return.
Gary, I know, sort of like when you're marching through the snow, when you're the first guy, when you do your first round, there's a fair amount of work in putting them together, the disclosure, the description of your business, your financial statements, describing your executive team and your capital structure and the like. Is the second round sort of like being the second in the line, that the first guy sort of has got a well-worn path and it's a lot easier for you?
Absolutely. I was able to throw this together very quickly with Paul's help and with the Wefunder guys' help. It was so much easier for us the second time around. I mean, there are things that you have to do as a growing company. So we do have our financials getting audited now. So that's like an extra step that we chose to do. But as far as setting this up, it really is extremely easy. I can't recommend it enough for people. It's the best way to raise money for your company.
That's terrific. That's terrific. And Paul, I know it maybe me and Ben stole your thunder a little bit on chatting with your lawyers first, but feel free to recap for us here. And then I think we've got some time for some of the questions that have been accumulating, and I'll ask people to feel free to pop them into either the Q&A or the chat, and we'll try to get to them.
Right. I definitely want to make sure we get to the questions, but there are sort of people like me, and I work closely with Next to help people, help companies, guide companies through this process, because as Gary said, they have other things to be worried about. They have the marketing part to be worried about, and they have the promotion part to be worried about. So if you sort of can leave the nuts and bolts and the behind the scenes stuff to us, that sort of is a worry off of your plate. So we can introduce you to portals. We can discuss the right financial instrument for you. Larry talked about the different ways to do that. Sometimes you might need to change your corporate structure. These are all things that have to be discussed beforehand. Before you really start getting into, the actual mechanisms of doing this. And then plus when you're testing the waters, when you're doing communications outside the portal, there are things that you should say, there are things that you should not say. And so we want to keep you legal with the SEC. The SEC is not a very fun agency to get on the wrong side of. So you don't want to knock on your door from them. So what we do, working with Next, is we help you concentrate on what you do best, so you get your maximum raise.
We should note that the SEC now, Ben has said that people have looked sideways at the crowdfunding world. I think the security regulators, they started out with a baby step. They let us all go into the deep end with the new limits. But at the same time, I think the industry is in the SEC's crosshairs. And within the last, I think it was 6 months or so, the SEC had their first crowdfunding enforcement action. Now it was against the cannabis company. So they had sort of like, I don't want to say two strikes against them, but they were certainly operating under a microscope. And like Paul said, I think this was a company that got in trouble largely for things that they said outside of their crowdfunding raise, related to their crowdfunding raise, but not things that were on the portal. And that's a point in time where if you're doing a crowdfunding raise, as Gary mentioned, there were things that we told him he shouldn't say today, that you want to be very careful during your communication strategy. It's all highly and very, very regulated. And so you want to be careful. And that's a place that certainly makes sense to have your own counsel for. And so with that, why don't we turn to some of the questions here. So Patty asked a question that I was asking myself yesterday, and Ben, I know you tried to address it, but I'll give you another bite at it. The difference between how does Wefunder differ from a community round?
That's a good point. It doesn't. I mean, community round is Wefunder, right? I mean, community round, Wefunder is home to the community round. All we're doing is we're basically trying to advance the dialogue that's been in place for the last decade. And what, if you're running a community round, that's what you're doing is you're raising technically a Reg CF round. The difference is that with the website itself, we're showing some really great examples of companies that are raising from their community. And on one side, founders can make a pledge to devote part or all of their future fundraise to the community. And on another side, regular people, proletariat, me, everybody else, whatever you want to call, can start petitions to invest in their favorite, to get their companies, like their favorite companies, to open a community round. So we've got some really fun petitions going around right now, just trying to generate interest to get these guys to open up a community round for them to invest in. But at the end of the day, instead of calling it crowdfunding, we are all about calling it a community round. And so that is just our stake in the ground for rebranding that term.
Terrific. And then there's a question about costs. And the next, working with Paul, we've got a very modest fixed fee package for crowdfunding, with half of the fees due upfront and half at the closing. You can reach out to us or Lisa to get that pricing. The other costs involved are your financial statement preparation, depending on the size of your round, whether you've got a round that you can self-certify, whether it can be reviewed or whether it can be audited. The extent that those the state of those financials are in today will drive, and the complexity of your operations will drive that. And then, Ben can tell you what the Wefunder fees are. And then on top of that, sometimes people come to us and they've got what we euphemistically refer to as corporate housekeeping that needs to be done first. That's the sort of thing that we talked about. You have an LLC. Do you need to be a corporation? Or all your equity issuances presently properly documented? Are you a foreign company? But if there's, we have certainly our share of people that come to us that don't need any housekeeping, and then it's just that flat fee, your accounting fee, and whatever arrangement you have with your portal, Ben.
Yeah, I mean, and with us, and just to touch on again, what you guys do, super great service. I've sent companies your way that are headquartered in Portugal or London, and they're doing this, and they want to be able to raise from U.S. investors, but they can't do it unless they're registered in the U.S. or whatever else. There's a lot of different things going on. You guys have been super awesome there and been very helpful. So thank you for that. And then in terms of the CPA stuff that you mentioned, it's if you're going to raise between 0 and 250, then it's founder gap financials. If it's 250 to 1.07, it's reviewed CPA financials. If it's 1.07 million to 5 million, then it's audited financials. So that's how you have to kind of look at it. From our standpoint, we are the most transparent pricing model in the industry. We only take a small fee based on check sizes that are below 25K. So it's just little, it's capped after that, and that's all it is. Unlike other platforms, some of them will take equity. They will charge you transaction fees. The processor that holds the actual funds will also charge you thousands of dollars and a per head fee to do some other ridiculous thing. So for us, again, public benefit corp, out there for the founders. We are the fairest, most transparent pricing out there, and I'm sure Gary will agree to that.
Yeah,
that's great, Gary. There was a question earlier that maybe Ben answered or somebody answered, so I'm not sure if I can see it. Oh, there it is. But it was the question was, do you know the investors? What percentage of your investors are people that you know versus people that are coming to you because they're in the portal universe?
The last time we raised, we did about 1,500 investors, and I think about 250 of them were our existing customers. So that tells you something of the ratio. Some of the others might have become future customers, but yeah, it's. But now this time, we did a testing the waters phase, and all the initial people that have come in are either customers or existing investors. We are about to go to the wider Wefunder audience now.
That's terrific. And then I'm going to try to hit one last question here before we end. Somebody asked, and Ben was kind enough to answer, does a crowdfunding work for a biotech company, even though you're looking at a 5 to 10 year time horizon? I think, Ben, you gave somebody a very terrific example. You said, obviously it does. I think Gary pointed out also, the idea is that your investors you have to convey to your investors that they're potentially in for a long road. Although, any investor in a biotech, it may be 5 to 10 years down the road for them to be revenue generating, or maybe they have some testing that results in them being acquired by a big pharma company, in 24 months or 36 months. So I don't know that path is necessarily that different. I mean, Gary's in a different place because they're generating revenues, which distinguishes them from a lot of early stage companies. But most early stage companies are looking at, realistically 5 year or so, time horizon for an exit.
Yeah, I mean, we have a lot of companies in the biotech space that have been raising. The challenge is, I was looking this up and trying to figure this out, but they're definitely bifurcated down to products, pharma, infrastructure. There's so many. So I actually encourage you just to go to the site and just in the explore section, just type in terms that, are relevant to what you're looking at, and then look for it. But yeah, people, of course, they want to invest in things that are going to have a massive impact on humanity, and whether or not that takes 5 or 10 years doesn't seem to be making a difference.
Terrific. And with that, I think we're at the end of our allotted time for today. So I'll thank everybody for joining us. If you've got questions that we didn't get to or questions that you didn't ask, the info@next.law is on the screen now. Lisa, if there are legal questions, we'll send them to me and Paul, and we'll get back to you if they're portal specific. Ben will get back to you. And if they're appropriate for Gary, we'll send them to him also. But I'll thank Ben, Paul, and Gary for joining us also. And thank everybody for joining us. Hope you found it informative.